If I were to start investing from scratch, I would do this, and only this. Becoming a successful investor isn't about finding a get-rich-quick stock. It's about building a repeatable, disciplined system. If I were starting my investment today with $0 in my portfolio, I would approach the markets very differently than most beginners. In this video, I would be sharing with you a professional blueprint for starting your investment journey with a focus on long-term wealth creation in 5 key chapters. Whether you are a curious beginner aged between 22 and 35 who have savings but are afraid of a market crash, or investors who have bought a few stocks but feel their portfolio is messy and lacks a coherent strategy, this video should give you another perspective to guide you through this investing journey. If you are new to this channel, welcome. This is Joe from the Investment Diary. I have been investing for the past more than 5 years and have consistently beat the market in the past 3 years with more than 20% annualized returns. I have traded Forex, commodities, stocks, and options, made painful mistakes and punished by the market, and I would like to share my lessons and journey of investing with you in this channel so we can both supercharge our investments. Support me by tapping on the like and subscribe buttons. For new investor, the greatest risk isn't a stock market crash. It's a liquidity crisis in your personal life that forces you to abandon your strategy at the worst possible time. If I were starting again, I would spend 90% of my initial energy here. You cannot build a skyscraper on a swamp. Chapter 1 is about pouring the concrete. Chapter 1. The Invisible Foundation. The Psychology of the Safety Net. Most beginners view an emergency fund as dead money, cash that isn't earning a return. A seasoned investor views it as emotional insurance. When the market drops 20%, and it will, the investors who panic and sell are usually those who lack a cash buffer. If you know your rent, groceries, and insurance are covered for the next 6 months, a market dip feels like a sale rather than a catastrophe. Without this, you're investing with scared money. And scared money rarely wins. High-interest debt, the guaranteed loss. Before you look at a 10% annual return from the S&P 500, look at your liabilities. If you carry a credit card balance at 22% APR and you invest in a stock hoping for a 10% return, you are effectively losing 12% every year. In professional portfolio management, we call this deleveraging. Clearing high-interest debt is the only investment with a guaranteed tax-free return of 20% plus. You must be at net zero on high-interest consumer debt before you earn the right to risk your capital in the markets. Defining your investment horizon. The grounded truth of the stock market is that over any 1-year period, the probability of the market being positive is roughly 75%. Over a 10-year period, that probability rises to nearly 95%. Before you buy your first share, you must categorize your money. Short-term, 0 to 2 years, high-yield savings or money market funds, for example, a house deposit, wedding, or vacation. Long-term, 5+ years, this is the only money that belongs in the stock market. Warning: why all these must come first before you invest. The biggest mistake I see is performance chasing. New investors see a sector like AI or green energy rallying, and they throw their rent money into it, hoping to double it in a month. When the market corrects, which is a natural part of the market cycle, these investors are forced to sell at a loss to pay their bills. This forced selling is the single greatest destroyer of wealth. The goal of Chapter 1 is to ensure you are never a forced seller. By securing your foundation, you shift from being a market participant, someone who reacts to prices, to a business owner, someone who can afford to wait for a company to grow. Bonus: I have prepared the first dollar checklist just for you. Before moving to Chapter 2, ensure you can check these 3 boxes. Debt filter: is my high-interest debt gone? The sleep test: do I have 3 to 6 months of cash in a separate account that I promise never to touch for stocks? The timeline: am I comfortable not touching this investment for at least 5 years? In good portfolio management practices, we don't just buy stocks, we manage exposures. Chapter 2 is where we move from saving money to strategically deploying it using a framework used by institutional fund managers, the core satellite model. Chapter 2, the 80-20 core satellite model. 1. The strategy, beta versus alpha. If I were starting again, I would stop trying to beat the market with every dollar. In the industry, we split returns into two categories. Beta, the return you get just for being in the market, for example, the S&P 500 going up, it's free growth that requires zero effort. Alpha, the excess return you earn by being smarter or more diligent than the average investor, picking individual winners. New investors often chase alpha and ignore beta. A senior analyst does the opposite. We secure the beta first, then hunt for alpha with what's left. 2. The core, 80%, the wealth engine. 80% of your portfolio should be in boring, broad market index funds or ETFs. The grounded truth, historically, over 90% of professional mid-cap and large-cap fund managers fail to beat the S&P 500 over a 20-year period. If the pros can't consistently beat it, a beginner shouldn't bet their entire future on doing so. The goal: capturing the aggregate growth of the world's best companies without the risk of a single company going to zero. 3. The satellite, 20%, the growth accelerator. This is the 20% where you get to be more creative and aggressive. You use this money to invest in individual stocks, sector-specific ETFs like technology or healthcare, or emerging trends you strongly believe in. One reason why this works is the psychological win. This 20% satisfies the urge to pick stocks and stay engaged with the market. The other key reason is to have a risk guardrail. If your satellite pick drops 50%, your total portfolio only drops 10%. This prevents a single mistake from being a game-over event. Here's a solid example for the first $10,000 allocation. If I had $10,000 to invest today, here is exactly how I would structure it to balance safety with high growth potential. 80% would be in U.S. index ETF as the core, for example, VOO, Vanguard S&P 500 ETF, or QQQM, NASDAQ 100 Index ETF, which provides targeted exposure to 100 of the largest non-financial, growth-oriented tech companies. These ETFs are extremely low fees and are suitable for long-term investing. The remaining 20% would be in individual stocks like Google, Microsoft, Amazon, and other high-conviction picks in a sector that I understand and believe in. On top of that, one analyst's edge is to perform portfolio rebalancing. The secret to this model isn't just the setup, it's the maintenance. Once a year, if your satellite stocks have done incredibly well and now make up 40% of your portfolio, you can choose to sell the excess and move it back into your core. This forces you to sell high, taking profits, and buy low, re-upping your foundation. It is a mechanical way to remove emotion from the selling process. The 80-20 rule is a guideline. If you are extremely risk-averse, you might do 90-10. If you are young and have a high risk tolerance, you might do 70-30 or even 60-40. But the core must always be the majority, at least for starters. Chapter 3. Finding your circle of competence. The core message: don't play a game where others have an unfair advantage. Play the game you are built to win. In the world of professional equity analysis and investment, we don't try to be experts in everything. A generalist analyst is often a dangerous one. Instead, we specialize. If I were starting over, I would ignore 9,000 of the 10,000 available stocks and focus strictly on my circle of competence. 1. What is a circle of competence? This concept, popularized by Warren Buffett and Charlie Munger, suggests that you don't need to understand every industry to be a successful investor. You only need to be able to evaluate companies within your area of expertise. Most people fall into the trap. Buying a biotech stock because you read a headline about a miracle drug, even though you don't understand clinical trials. This is the professional approach I recommend. If you are a software developer, you understand churn rate and API integrations. If you are a teacher, you understand EdTech adoption. That is your edge. The 3-filter framework. To find your satellite stocks, the 20% of your portfolio, run every idea through these 3 filters. Filter 1. Personal experience. Do you use the product? Do your friends? Is the user experience improving or declining? For example, are people switching from Google search to AI tools? Filter 2. Industry dynamics. Is this a winner-takes-all market? Does the company have a moat, a competitive advantage like a brand, patent, or network effect that prevents competitors from stealing their profits? Filter 3. The Lindy effect. The longer something has lasted, the longer it is likely to last. For a beginner, investing in a 50-year-old brand with a proven track record is often safer than a 6-month-old disruptor. Here's a solid example on spotting a moat in 2026. Let's look at a grounded example of a company with a massive network effect moat, Microsoft MSFT. If you work in a corporate environment, you likely use Excel, Teams, and Outlook. You have the circle of competence insight. You know that for a company to switch away from Microsoft, they would have to retrain every single employee and migrate decades of data. That is a high switching cost. Also, you need to tie it back to the grounded truth. This isn't a tip, it's an observation of a business reality. As an analyst, I don't just see a software company, I see a utility for the modern workforce. 3. Staying within your bounds. The most important part of this chapter is knowing when to say, I don't know. Professional analysts have a too hard pile. If a company's business model is too complex to explain to a 10-year-old, it goes in the too hard pile. Your edge, you aren't forced to buy anything. Unlike a fund manager who must deploy cash, you can wait for the perfect pitch to enter your circle. Bonus. Here's the competence action plan that I recommend you to start and identify your circle of competence. 1. List your top 3 hobbies or professional skills. 2. Identify 2 to 3 public companies that dominate those spaces. 3. Start your research there. Don't look at the stock price yet. Look at whether the business is getting stronger or weaker in your eyes. If you enjoy content like this, make sure to like and subscribe, as I will be posting more videos about investing this year. Chapter 4. The Analyst's Checklist, aka the Verification Test. The core message here is simple. Qualitative stories get you interested. Quantitative data gets you invested. In Chapter 3, we identified a company within your circle of competence. Now we must move from I like this product to I trust this business. As a senior analyst, I never take a management team's word for it. I use a verification checklist to see if the numbers tell the same story as the marketing. Pillar 1. Revenue quality and growth. We don't just look for sales, we look for revenue quality. The metric for revenue quality and growth is compound annual growth rate, or CAGR. A single year of 20% growth could be a fluke. We look for a 3-year or 5-year CAGR of at least 10%. Question you should ask yourself is this: is this growth organic, selling more products, or inorganic, just buying other companies? Organic growth is far more sustainable. Pillar 2. Cash flow reality. The truth metric. Profits, or net income, are an accounting opinion. Free cash flow is a cold, hard fact. The cash flow reality can be identified by taking operating cash flow minus capital expenditures, or CapEx. If a company reports $1 billion in profit but has $0 in free cash flow, they aren't actually making money. They are spending it all just to keep the lights on or pay for expensive equipment. A healthy company typically has a free cash flow margin of 10% or higher. Pillar 3. Capital efficiency, ROIC. This is the single most important metric for professional analysts. Return on invested capital, or ROIC, tells us how much profit a company generates for every dollar of capital, both debt and equity, it puts into the business. We look for an ROIC consistently above 15%. If a company's ROIC is lower than its cost of capital, or the interest it pays on debt and the return shareholders expect, it is actually destroying value the more it grows. It's like a car that burns $2 of fuel to deliver a $1 package. Here's a solid example for you. Google. We use Google's search engine, watch YouTube, and maybe use Gmail for work. However, I don't just buy a stock because I like the app. I run it through a ground truth verification test using actual financial data from 2024 and 2025. And that is what we are going to do together. Pillar 1. Revenue quality and growth. We look for consistent double-digit growth to ensure the moat is still working. The grounded truth. Alphabet's revenue in FY 2024 was $350.02 billion, a 14% increase over the previous year. Even more impressive is the 5-year trend. Revenue has grown from $161.9 billion in 2019 to over $350 billion in 2024, a compound annual growth rate of approximately 16.7%. The analyst's verdict. This shows that despite being a massive company, Google is still finding organic growth in search, YouTube, and cloud. Pillar 2. Cash flow reality. Profits are an accounting opinion. Cash is a fact. We check if the net income is backed by real money coming in the door. The grounded truth. In 2024, Alphabet reported net income of $100.1 billion. When we look at the cash flow statement, their cash from operations was $112.4 billion. The analyst's verdict. When cash from operations is higher than net income, it's a high-quality signal. It means the profits aren't just paper gains. The company is a cash-generating machine. Pillar 3. Capital efficiency, ROIC. This is how we measure if management is actually smart with the money they reinvest. We look for a return on invested capital above 15%. The grounded truth. As of the trailing 12 months ending September 2025, Alphabet's ROIC was approximately 26.6%. The analyst's verdict. Alphabet earns 26 cents for every $1 they invest back into the business. This is an elite level of efficiency, far exceeding the typical cost of capital. Based on 2024 and 2025 data, Alphabet's performance beats all professional benchmarks for the metrics of revenue growth, operating margin, ROIC, and free cash flow. But wait, even a pass needs a critical eye. In 2025, Alphabet significantly increased its capital expenditure to a range of $91 to $93 billion, largely to build out AI infrastructure. As an analyst, I don't just see AI excitement, I see a massive increase in spending that must result in future revenue. If that ROIC starts to drop toward 10% because the AI investment isn't paying off, that's when the buy thesis changes. This is the difference between a fan and an analyst. We watch the numbers, not just the headlines. If you've stayed this far in the video, here's another bonus for you. The red flag checklist. If you see any of these, stop your analysis immediately. Declining gross margins. This means the company is losing its moat and has to cut prices to stay relevant. Rising debt to equity. If the company is borrowing money to pay its dividend or buy back shares, it is a house of cards. The gap. If net income is growing but operating cash flow is flat or falling, the company might be using aggressive accounting to hide weakness. Chapter 5. Master your emotions. Behavioral finance. The core message. Your biggest enemy isn't the market. It's the person in the mirror. As a senior analyst, I've seen thousands of brilliant models and perfect stock picks fail. They didn't fail because the math was wrong. They failed because the investor couldn't handle the volatility. In professional finance, we call this behavioral alpha. the ability to remain rational when everyone else is panicking. Number 1. The loss aversion trap. Science tells us that the pain of losing $1,000 is twice as intense as the joy of gaining $1,000. This is a survival instinct, but in the stock market, it's a liability. In a market correction, a 10% drop, your brain will scream at you to do something to stop the pain. Usually that something is selling at the bottom. Since 1950, the S&P 500 has had a 10% correction roughly once a year on average. If you aren't prepared for a 10% drop, you aren't investing, you're just hoping for good weather. Number 2, time in the market versus timing the market. Many new investors try to wait for the dip or sell before the crash. If you invested $10,000 in the S&P 500 from 2003 to 2023, you would have seen a significant return. However, if you missed just the 10 best days in those 20 years because you were trying to time the market, your final return would be cut in half. The strategy here is simple. Use dollar cost averaging, or DCA. By investing a fixed amount every month, you automatically buy more shares when prices are low and fewer when prices are high. This turns volatility into your friend. Number 3, the inversion exercise. Before you buy a stock, perform a pre-mortem. Ask yourself, if this stock drops 30% tomorrow, why would it happen? Maybe it's a general market crash, which has nothing to do with the company's quality. Maybe a competitor launched a better product, which breaks your circle of competence. If the drop is just market noise, you stay the course. If the drop is because the business fundamentally changed, you sell. Never sell on price, only sell on fundamentals. Conclusion: the professional blueprint. If I were starting again today, I would stop looking for multi-baggers and start looking for consistency. Here's a quick recap of what we covered in the different topics. Chapter 1, Secure your foundation, debt-free plus emergency fund. Chapter 2, Build your 80% core, index funds, and 20% satellite. Chapter 3, Stay within your circle of competence. Chapter 4, Verify everything with the analyst's checklist, revenue, cash flow, ROIC. Chapter 5, Automate your habits and ignore the noise. Remember, investing is a marathon, not a sprint. The boring path is usually the one that leads to the most exciting wealth. Now, everything we've talked about today, the core satellite model, the ROIC checks, the behavioral discipline, it only works if you actually write it down. In the financial industry, we call this an investment policy statement. It is your financial constitution. I've actually created a template for you based on the exact same structure I use as an analyst. This document is your sober self talking to your panicked self. When the market is down 10% and your screen is red, you don't look at the news, you look at your IPS. If the company still passes the analyst test, you do nothing or buy more. This is the roadmap for you to follow when things get stressful. You can grab that template for free at the link in the description. If you found this professional perspective helpful, hit the like button. It helps the algorithm show this to other new investors who might be gambling instead of building wealth. And subscribe if you want more grounded, analyst-grade stock deep dives. That's it for today's video. See you in my next diary.